Good afternoon, everyone. I'm told I'm to speak about the banking reforms, and in particular within the context of this theme, the issues of banking reforms and sustainable finance. In 2007, I mean, as we all know, Nigeria is a country with GDP of over $200 billion, second largest economy in Africa after South Africa, growing at a rate of 6, maybe 7% annually for the last 10 years. Oil is about 13 to 15% of GDP, but plays a disproportionate role in the economic stability of the country. It accounts for over 90% of export earnings, and directly or indirectly, almost 80% of government revenues. So go back to 2007, where at one point, oil price went up to over $147 a barrel. And the country built up reserves that at one time exceeded 62 billion US dollars. And then 2008, 2009, when oil price at one time dropped to under $40 a barrel. And you can just imagine what that would do to an economy that is so vulnerable. So every time the price of oil goes up, the money comes into government's balance sheet, it's monetized into the local economy, and naturally finds its way into the capital market and to the properties market. And you have these bubbles that are built up, and you've got two highly correlated bubbles. Now, the Nigerian banking industry, like other bankers all over in many parts of the world, decided that the opportunities presented by these bubbles were simply too good to miss. And you had huge exposures to stockbrokers, huge exposures to investors in the capital market. In 2007, the Nigerian capital market was the best performing capital market in the world. In 2009, it was the worst performing capital market in the world. You also had a lot of fraud where the management of banks set up all sorts of special purpose vehicles into which they took depositors' funds in the name of, in theory, arm's length loans. In fact, these were insider loans, and the money was then used to trade. We had this situation where the banks had these exposures, and then all of a sudden, after Lehman Brothers, oil price crashed. The capital market was on a bubble driven largely by very high oil price. Once oil price crashed and the liquidity went out of the system, the capital market crashed. And then the banks that had huge exposures to the capital market found their capital wiped out. And invariably, those same banks also had taken huge risks. In any event, at the time I became governor, the economy was in serious trouble. You had about a third of the banks clearly totally undercapitalized, about to collapse, and these accounted for 30% of total liabilities, 40% of risk assets in the industry. But far more important, and this is, I think, one of the big lessons of managing a crisis, was that there was a confidence crisis. If you look at what's happening in Europe, basically, even if you recapitalize the banks, even if you provide liquidity, you still need to rebuild confidence. And this was a time when everybody was in denial. And everybody knew that given the fact that Nigerian banks were 70% of the capital market, and given the exposures of the bank's capital market, it was simply impossible for those banks to have been immune to a crash in the capital market. So one of the first tasks before me at that time was to re-establish confidence, because without confidence, you don't even have a chance to fix a problem. The markets have to, first of all, believe that you understand the problem and that you have a plan for fixing the problem. And I was fortunate in that I had about 3 months' notice quietly of my appointment, and therefore I'd had time to read up on the Asian financial crisis, and decided that the model that the Malaysians adopted in response to the crisis was probably the most successful at that time, and we would broadly try to do what they did. So there were some ideas about how to fix the problem. What nobody knew was that the problem was not just about banks lending to stockbrokers and share prices going down. it was also about banks over years, or bank CEOs, individual CEOs actually stealing from the banks. You only know the banks that are well run when you have a crisis. So this is basically what happened. When you now need 10, 20, 30% of a bank's balance sheet, then you realize that, frankly, all of that money has been thrown into assets that are not liquid, which is fine. If it's a liquidity problem, we give a short-term liquidity support. But if it's actually gone, it's been wiped out, blown away, then there's very little hope. You actually need to recapitalize the institution. So we sent in examiners, and we discovered that 8 out of the, the first round was 10 banks, and we discovered 5, and then later the balance of 14, and we discovered another 3 or 4, basically had negative capital. It's a difficult position for a central bank governor to be in, to come out and say, listen, 1/3 of my banks are in trouble. Anything can happen. The investors can decide to punish you and just run away, and then the whole house collapses on your head. And this is like 2 months after my appointment. But we decided we would come out with a problem. But we also decided that we're going to save the banks. However, unlike some of our friends over here, we decided that we're going to hold individuals responsible for the actions and decisions that they took. So the first thing we did was to basically fire the executives of all those 8 banks. We had to put in money, obviously, to provide what we called life support. We placed those banks on life support to take them to a safe harbor. But we had to deal with the big issue: how do you recapitalize the institutions? The Europeans have this European Stability Fund, and they're debating over whether to put in the money or not put in the money. For us, we knew that the only way the banking industry would come up was for the banks to be recapitalized. And so we set up, through legislation, a company called the Asset Management Corporation of Nigeria, AMCON. And what we did with AMCON was to look at a number of institutions that were set up in Malaysia after the crisis, and basically roll them into one vehicle. Malaysia has the Dana Harta, it has the Dana Modal, and that's a corporate debt restructuring desk. These 3 were critical to solving the financial crisis in Malaysia. One was a traditional resolution trust company that dealt with the issue of non-performing loans by purchasing them at the value of the collateral. And so the other institution had the role of injecting capital into the banks and bringing the banks to zero. And so we had AMCON that could do both. Purchase non-performing loans and also inject capital. But we injected capital on a number of conditions, prime among which was we would only inject capital if the bank found a partner that was willing to take it over and merge. So we moved capital adequacy ratios in the banking industry from about 3%, 4% average, to now about 20%. Nigerian banks are among the highest capitalized banks in the world. Liquidity ratios about 70%. Non-performing loan ratios down from 40% to 5% through the cleanup of AMCON. And AMCON did not just buy non-performing loans. It bought some performing loans that had huge concentrations and therefore posed a systemic risk to the Nigerian economy. So what are the key issues where sustainability is concerned? We decided to anchor our reforms of the banking industry around 4 key pillars. Okay, the first pillar is to enhance the quality of banks themselves. And this basically meant looking at their capital position, making sure they've got strong liquidity, looking at management. We've issued what's called a competency guideline. We've identified about 45 key offices in banks and issued criteria and qualifications and competency levels. So forced banks to think through succession and continuity. So we set rules that make sure that no bank can have a CEO that serves in that position for more than 10 years. No person can serve as a non-executive director in a bank for more than 12 years. We've gotten banks to take a common year end. We've talked about IFRS. We're taking certain elements of the Basel guidelines. We're not we don't really accept the whole of Basel II or Basel III hook, line, and sinker, but we do think there are a number of strong points. We've adopted our own Volcker rule, basically broken up the banks. We no longer have banks operating as commercial banks and investment banks under one roof. So there are about 3 banks that have opted for what we call a holdco model, which clearly sets out the banking business from the trading business and in a transparent manner. The second is re-establishing financial stability. But we're also sitting on huge risks long term unless other things are done. There's a limit to how much monetary policy can achieve. So you can have very high yields in the fixed income market. You can have recovery in the capital market. You can have a stable exchange rate. You can have stable inflationary expectations. And what does that do to you? You get a lot of portfolio flows. And they're good because you build up reserves, your exchange rate is stable, and you're able to maintain that stability in the short term. Long term, if there is a shock, they move out as quickly as they came in. The big risk that we had of AMCON has just been resolved because what we're doing is by December, AMCON is going to pay off 1 trillion out of its indebtedness. Next year, it pays off another trillion. By the end of next year, the only creditor to AMCON will be the Central Bank of Nigeria, holding 3.6 trillion naira in AMCON bonds at 6%. How is that going to be paid for? The Nigerian banks. We have agreed, but we haven't imposed. We've agreed with the Nigerian banks. They're very generous people. Every year, every bank will put in 0.5% of its balance sheet into a sinking fund. So the Nigerian banks are paying the cost of the cleanup of the banking industry. So we're not imposing any, over the next 10 years, we're not imposing anything on the taxpayer. Now, the third element after financial stability is basically ensuring a healthy evolution of the financial system. One of the major problems you have in sub-Saharan Africa, if you take out South Africa, is the very shallow and narrow nature of capital markets, for example. Okay, and now what the result is that you have banks as financial institutions taking on roles in asset creation that are beyond what banks should do. So the whole idea of the central bank working with other regulators and the finance ministry and the government to see how long-term saving can be channeled through the appropriate institutions, for example, pension funds investing in infrastructure bonds for the purpose of power and refinery and road projects, as opposed to banks lending depositor funds, is critical for evolution of the financial system. One of the concerns for us is how do we encourage and how do we license, which is why we then had differential capital requirements, had what we called international banks that operate in Nigeria and abroad. We had national banks that can operate across the country, and we said we want to have what are called regional banks. And the idea of those regional banks is to recreate those small institutions that will now focus on the cocoa processor in Ibadan, the small spare parts dealer in Aba, the small textiles factory in Kano, rather than go and be lending 20 billion naira to MTN. The final element of this reform, the fourth pillar, is ensuring that banks actually contribute to the real economy. And to do this, we've had to go beyond the traditional role of a central bank. We've been very conscious of the fact that we're in a developing economy. And maybe to understand this, we've got to go back to my first point. Why is it that banks, for example, do not lend to agriculture? And agriculture is 42% of Nigeria's GDP. Getting banks to lend to the real economy has involved an intense engagement with government, an intense criticism of government economic policy. Those are the four pillars: enhancing the quality of banks, establishing financial stability, ensuring healthy evolution of the banking system, and ensuring that banks contribute to the real economy. Thank you.